Hello everyone, welcome to my channel. Don't be fooled by the recent market gyrations. They are very incredible in my mind. Monday we had the worst trading stock trade day of the year. It went down about 3%, the S&P 500. On Thursday, we had the best trading day of the year. The S&P 500 went up about 2.6%. So it didn't make up quite what it had lost on Monday, but it's a hopeful trend. And people are hoping that next week it will come through and it will improve. But there are many serious factors you have to take into account that weigh heavily against this market. Also, my experience with downturns in the market like this is you get the 1, 2, 3 punch if it's a major downturn. First, you get a dead cat bounce, which is more or less what this was, given how the previous weeks have been going. And then you get a second deeper cut, and then you get the third smasher cut. Okay, you don't want to be fooled about these market gyrations. That it's still a major downtrend. Let's look at the reliable indicators that a recession is probably headed our way. The major one is the SOM rule, developed by Claudia Somm, an economist who works with this, and the Federal Reserve works with this to warn them early on of a recession. And that's when the 3-month continuing moving average of the unemployment rate goes up 0.5 over the previous year, over the low point of the previous year. And it's been 100% reliable so far. You will hear people say, oh, there's reasons why it wasn't really triggered. It was triggered. Okay, I was looking for 0.2 to trigger it, and the unemployment rate increased by 0.3. That's just a major uptick. You got a recent jobless claims number that was a little bit lower, and that signaled a major rally on Thursday, which is really just kind of ridiculous. The Monday trade was influenced by the unemployment, but it was also influenced by Japan. They called the Japan carry rate, and that's big institutions use the Japan currency to carry a trade. They get the currency from Japan and buy assets in other countries because Japan's interest rate is very low. It's all very complicated, and it's a way of them using arbitrage to make a sure 4%, and then they leverage the heck out of it, and so it goes even more ridiculous. So it's way more important than what it would appear to be. But what you should know is if the Japan yen gains in strength, if they raise their interest rates, which they have been doing, or the United States lowers its interest rate, which we now are threatening to do, it is a very negative effect on our stocks. So when the Fed starts to cut rates, it actually will make this Japan carry trade worse, which is many times part of the reason for thinking that it should go down when they lower rates, which is counterintuitive because you think, well, it's good news they're lowering rates. It's partly this carry trade idea and partly that, hey, the Federal Reserve has finally concluded that our economy really sucks. Another reason you don't want to be fooled is the seasonality factors are strongly against you. September and October are famous for not being very good for investors. It's a good time to buy because usually the stocks go down in September, October, and then you get a little Christmas rally. You know, that's not always true, but it's true a lot of the time. A lot of the time you can take advantage of it, and I might just be taking advantage of that. That's more what I'm looking forward to. You also have the elections, and what a wild election election year we have. I am so glad there's finally some hope in this election, some hope and joy being brought to this election and taking us into the future. That could be part of the reason stocks are rallying. Stocks react emotionally to the general sentiment of the country, and that could be helping in a way. Another factor I carry strongly within me is I'm very hesitant to go against the greatest investor in the world, Warren Buffett. He sold half of his Apple stock. It was his biggest stock holding, okay? And he also sold billions in Bank of America, which he has owned for years. He's got a war chest. He's got like 277 billion. It's getting close to 300 billion. It's going to work its way to 300 billion. He's piling a war chest, and I think when the greatest investor is doing this, he's giving a signal, probably what you might want to be doing, which is building up your cash and getting ready for the big plunge. It might not be a big plunge, but it's probably going to be at least a drawdown. And I think the most cheery thing I have to say is we could be having a Merry Christmas if we buy in October and November. I pick an arbitrary date many times in these cases, and in my mind I have November 22nd in my mind because I like to pick an arbitrary date of when stocks are likely to take off in anticipation of the Christmas rally. And I found sometime in November probably to be very good. Although if it crashed hard in October and then started to spring back, I might jump in then. The factor that's going against there being a recession immediately is the gross domestic product, the GDP. The GDP as estimated by the Atlanta Federal Reserve. Looking at this chart, you can see that the Atlanta Fed estimate is near 2.9%, okay? And that's actually pretty healthy. But what is that coming from? What it's coming from is government spending. The government is spending massive amounts on the CHIPS Act to promote semiconductors in this country. It's doing massive spending on the infrastructure bill that will extend out for years. And it's also involved in a major war supplying Ukraine with weapons. All of these are very stimulative and work against the Federal Reserve reducing interest rates. And that's why they are having such a hard time getting it down to the 2%. It's because the government keeps stimulating the economy. This even works with jobs. It's been noticed that the federal government has been supplying much of the jobs in the recent better jobs numbers. So a lot of government spending is clouding what is actually going on in the economy. Although this is part of what's going on with the economy, the government spends more, it's going to be stimulative. But I think it's kind of cushioning the blow from the coming recession, which they intend to do. And it is an election year, so it will be especially pronounced that they will do everything they can to stimulate this economy. Next week, the big number will be the Consumer Price Index, the CPI. The biggest number next week will be the CPI, the Consumer Price Index, on Wednesday, August 17th. The month-on-month change in the CPI, looking at the chart for July 2024, indicates that it will be rounded to a 0.2 increase on the CPI, a month over month on the CPI, and it will be rounded up to 0.3 on the core CPI. So a 0.2 increase on the headline number and a 0.3 increase on the core CPI number. And looking at the year over year inflation for July 24, the CPI will come in at about 3%, and the core CPI will come in at about 3.3%. They rounded to the nearest tenth. So these are good numbers. They shouldn't be a big problem. The biggest problem will be is if inflation drops dramatically, because that indicates a recession's coming on. We still got more than a month to go, almost 5 weeks to go, until the Fed decides whether it's going to cut interest rates, and there's a lot of speculation on this. Right now, looking at the chart, you can see there's a 51% chance they will cut it by a quarter of a point, and there's a 49% chance that they will cut it by a half a point. I personally believe he's going to cut it probably a quarter of a point, simply because I think he wants to do a quarter of a point each time to keep it orderly and predictable. I will put a caveat on that. If the CPI spikes up dramatically on this Wednesday, I will guarantee you he won't cut rates at all. On Thursday, we're also going to have initial jobless claims, which came in at 233,000, which surprised the market, and the market jumped forward. This time it's expected to go up to 235,000. And I don't expect a big reaction to that. It's just if it jumps up above 240,000 or it goes down below 225,000, let's say, then you would get a big market reaction. If initial jobless claims came in over 250,000, that would indicate that a recession is on the way. It's possible we may get a short-term bounce here. You know, when you've had come downs like this, it wants to bounce back to some degree. But I think it's very timid how it is bouncing back. I don't think it's sustainable. I don't think the data support it. I think it's ultimately going to go down for another dip into the threat of recession.